Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He covers markets extensively over at MacroAdvisor. He also has a trading service, TraderAid. You see his business partner, Aisha Tariq, on Fox Business, CNBC, and Bloomberg News almost every day, Monday through Friday. Mayhem of Markets and Mayhem. Thank you for joining me again.
Hey, Jason. Thanks for having me back. How you doing?
Doing all right. Happy New Year to listeners out there. We're a couple weeks after January 1st here on Thursday, January 16th, 2025. Really weird stuff going on in some of the markets right now. The G7 central banks, they started doing rate cuts months ago, and yet the yields, the government bond yields have started to rise. Is that one of the biggest surprises that you've seen the last couple months, or are there other surprises?
I like that question a lot because I've been seeing more and more chatter about this out there, and it is very interesting. Not often, and in fact, in the case of what we're seeing in the US, ever have we seen the 10-year yield move this much higher after Fed rate hikes or Fed rate cuts. Let me go back there and say that when the Fed cuts, and they've cut by 100 bips, after the first cut, typically you see the 10-year yield move a little bit higher and then start to move down. Right. So the initial knee-jerk reaction, usually when the Fed's cutting, it's, kind of at a time where you have a little bit of a maybe 10, 15 bips move higher. And then after that second cut and that third cut, when the economy really is slowing down more and more, because they're typically cutting into a slowdown or even a recession, then you start to see that long end moving lower because the economic concerns that typically drive yields higher aren't present. Right? It's the opposite. People get more concerned about preserving capital. They start rolling out of the more risky elements of the stock market and putting on more long end exposure in the bond market, hoping both to preserve and potentially appreciate capital and also get a steady yield. And so fixed income becomes more attractive. But what hasn't happened this time? Well, the Fed wasn't cutting into a slowing economy, really. I mean, to some moderate, mild degree, sure, but in the aggregates of data. When we look at unemployment, when we look at JOLTS, when we look at the overall health of the labor market or aggregates like the GDP or retail sales or PMIs and services, which is most of the economy, it's like 72%. All of that at the surface level has been pretty resilient. Yes, there's a K-shaped distribution of economic outcomes. Lower tier consumers, earners are all getting hit pretty hard. Smaller businesses, manufacturers, they haven't been doing well. But on the other side, larger businesses, the services industry, federal government spending, more affluent households, all of that's been pretty robust, right? The balance sheet of the consumer in aggregate is still doing okay. So I'd say that the Fed's been cutting into a market at all-time highs, with crypto at all-time highs, with gold at all-time highs, housing prices at all-time highs. And I think when you go out to the long end of the yield curve and you see the reaction to the Fed, which this time is so much different, and it's historic. It's the biggest reaction like this that we've ever seen in a Fed cutting cycle on the long end. I think it has a lot to do with the long end saying, you know what, we're sniffing out a few things here. One, we're not convinced the battle against inflation is over. We think the right tail is bigger than the left tail here. And two, the economy is showing us more uncertainty, but a bit more uncertainty to the upside. And when you look at these economic cycle kind of four quadrant type of thought processes, we're kind of in that boom part of the cycle where you typically see that bear steepening. So the long end moving up in rates in excess of the short end, right? And also an appreciation in the price of commodities and cyclical stocks, kind of older economy stocks. So I think we're transitioning into that part of the market cycle, that boom cycle. And unfortunately for the Fed and other central banks, that also means the long end is kind of rebelling. So it's a long-winded way of saying they cut too early. And by cutting too early and into such strength, they've actually kind of helped this outcome to come about, because when you reduce the cost of capital, you reduce what it costs to grow an economy, but also to increase demand potentially in excess of where there's supply.
Well, I mean, the rumors were that Janet Yellen was lobbying Jerome Powell for months before those rate cuts. So, I mean, she was really worried, I think, about getting the US Treasury funding and the interest payments on the national debt. I mean, the base case now it's $1 trillion per year base case interest payments on the national debt. The national debt is up enormously. What we're over $36 trillion when we're recording this. It's growing at what $1 trillion seems like every 90 days or something like that, 90, 100 days, give or take. So it's growing at a lot faster pace. We're not back at the zero interest rate policy levels where the base case was $300 billion, give or take, per year in interest payments, where the new normal is like over three times that.
So, one of the things that I think we also need to come back to is the fact that when Fed QE policy was in effect, that was like having an interest free credit card. The Treasury would borrow, the Fed would come to auction, they'd buy. They were the biggest buyer post great financial crisis at a lot of the auctions, and they'd buy all across the duration curve. And when they were doing that, when that debt would mature, the Fed would be paying back all of that interest every year. So, and when that debt would mature, they'd be buying more debt, right? Because it would be part of keeping their balance sheet at a certain level or even
Do
growing
you
it. So,
mean remittance? Do you mean like the Fed giving the Federal Reserve Bank giving a $80 billion per year remittance to the U.S. Treasury, kind of like a rebate then?
yeah, basically, like whatever interest was earned on their balance sheet, every year they would net out their expenses and pay that interest back. And that still goes on to this very day, albeit with a somewhat smaller balance sheet and a lot of it at lower interest rates than what the Treasury's selling debt at now. So there's kind of that double barrel shotgun effect for the Treasury because, on the one hand, they don't have that sort of price and yield agnostic bidder coming in size to keep the treasury market liquid and supported with just a permanent bid under every auction. And two, you do have more folks that are still hesitant on the long end. Why would you or me as a fixed income investor want to go all the way out to the tens just to get a very small risk premium versus the bills? To me, it doesn't make sense. I can get bills going out from months all the way up to a year and easily get close to 5% interest. Why do I need to go out to a 10 and get just about 5% interest? I'm not getting enough of a premium there. It's what, like 30, 40 bips? So for me, it just doesn't make a lot of sense to take the duration risk. And I think that it makes a lot more sense if the 10 starts to get closer to 5.5 or 6% to maybe consider that as part of one's fixed income bond ladder strategy. But for now, I prefer bills. I prefer AAA corporates. I prefer tax-free munis and AAA rated municipalities versus any of the long duration stuff. And unfortunately, the government's got a lot of refinancing to do this year. Like you said, interest spend is at a record level. It's now bigger than the DoD budget, which is already a huge part of our budget as well. So it shows you how much that's swollen. And yet, the only thing the government can really do is kind of hope that the economy slows down and rates come down. And yet there's an agenda that could push things the other way, which is not a bad thing for the economy, but might not be a great thing for the government's debt load or its serviceability. And it could also, in some ways, put future constraints on policy because you've got folks that want to reduce that deficit. You've got folks that are talking about that right now within the narrow majority that the Republicans were able to get in the 2024 election as well. So, I would say that we're kind of in a period right now where there is likelihood that that long end can keep pushing higher. I think that bear steepening, which is one of our base cases for later half of last year and going into this year at MacroAdvisor, that can continue. And I think that that's one of the reasons that for now, the long end is not really investable unless you're dollar cost averaging and you have a very long time horizon.
Well, I see a lot of different cross currents, macro ones, and then red flags with other government bond markets too. So it's not just the US, like you said, with the bear steepening. I mean, these other central banks started cutting rates before the Fed and the G7 with the Bank of England, the European Central Bank. And now we're seeing yield spikes the last couple months in German government bond market, in France, in Japan, in England. So there's red flags here in all these government bond markets. It looks like a pretty serious long-term duration risk government bond bear market, potentially similar to the 1940s or 1970s stagflation, where the governments are monetizing debt and they don't want to cut back on spending.
It does feel like that, and there's no political appetite for austerity. And if you think about it, if you're looking at these governments, you're looking at their debt load, you're looking at the aging populations, and you're saying, well, gee, how do I expect to get paid back? What are the chances they don't debase their currency pretty appreciably from here to pay back this debt with much cheaper paper? And at that point, the only thing you can do as a fixed income investor is demand a higher premium. And the only way you can do that is to not buy the longer end. And I feel like that's becoming more of a theme because people are concerned about these policy mistakes. Central banks have been, often very reactionary. This time they're trying to front run the sort of end of the fiscal excess cycle that was largely led by US spend. That was one of the reasons we didn't hit a rougher patch in 2022. Because if you think about it, we had this combination of authorizing all this fiscal spend. Then for the first half of 2023, there was the suspension of debt issuance that was liquidity positive. Then we got into the second half of 2023. We started to see more of that fiscal impulse permeate through the economy and the financial system, bringing up bank reserves, countering the effect of rate hikes, countering the effect of quantitative tightening more and more. Now there's this attempt to hand the baton back to the central banks to keep them stimulating and to keep liquidity flowing. The problem is, the central banks kind of have their hands tied. They're realizing this game can't go on because they preempted the cycle, and they did it twice now. First, it was the fiscal side, preempting a global slowdown in 2022. Now it's the monetary side. And I think the fixed income market's saying, you know what? The right tail on inflation and debasement is too high for us to ignore in duration.
We have a weird mix now. I mentioned Crosscurrents a couple of minutes ago. And by weird mix, what I mean is there's a combination of kind of flight to safety where there's flight capital from these other markets, Mayhem from like Europe, emerging markets, China, and it's coming into US capital markets, the S&P 500, Mag 7, Nvidia. But then also you have a lot of risk on behavior, also into the dollar index, which is around 109. I think the dollar index has had a substantial rally. So that normally means flight capital risk too as well. If the dollar index is spiking, despite the 10-year US treasuries. But then also you have, on the other hand, you have risk on behavior, the gambling mentality lately, from meme stocks, sports betting, quantum computing stocks, artificial intelligence stocks. It's just a weird mix of things that's been happening right now. But it seems the US capital markets are getting a lot of this attention compared to the other countries' stock markets or capital markets.
And I mean, I think it makes sense in a way. It really is much more tempting to want to do business in the US. We have really liquid financial markets. We've got attractive long-term rates versus some of these other markets. Like, would you rather be an Italian 10 years or French 10 years or US 10 years? So I think that at least makes somewhat of a case, but I don't think it's enough of a case to keep rates from moving a bit higher from here as well. But you're right, in terms of that risk on appetite, we've got a lot of global capital wanting to chase the momentum here, particularly in our technology companies and in the growth segments that ran really hard. On the other side of it, I do think that rising rates and a rising dollar, some of that having to do with that capital flight, some of it having to do with rates really leading the dollar too. From the December lows in the dollar and in the 10-year, the correlations jumped to a rolling level of about 0.84. And that's just over the last 20 trading days in the dollar versus the treasury. So we can see more and more versus that 10-year yield. The dollar is following it along, kind of getting pulled lockstep. And while positioning in dollar future longs is really extended, it's like at levels we haven't seen, I think, in like 6, 7, 8 years. On the other side of it, as long as interest rates are rising, this kind of move can keep creeping higher. It just sets up a bigger left tail. If we see a reprieve in rates, if you see some relief in those interest rates, the dollar could really start to be led lower by the same. So I think we've got to look to some of what's going on with rates too, because it just makes the dollar a more attractive destination in US cash markets in particular, where we still see folks piling into money markets and seeking refuge in treasury bills as well. There's been absolutely no shortage of demand on the short end of the yield curve. I think that's another part of it. Outside of the risk spectrum, there's plenty of opportunities for nearly risk-free exposure to fixed income on a short duration, and also with some of that potential for appreciation. I mean, you're in a currency that's moving higher, so you're kind of going on the other side of that hedging risk. And so that's been good for folks coming into US assets. It's also been really bad for folks trying to go into other countries' assets, particularly in emerging markets, because you think about it, that double barrel shotgun effect of the 10-year moving higher, where about $100 trillion of global debt keys off that interest rate. So it's becoming appreciably harder to surface, just with the interest rate moving up the way it is. Then you consider the dollar exchange rate, because a lot of that debt is also dollar denominated, and it's becoming a bigger pressure valve on emerging markets. And ordinarily, when that sort of situation's happening from other factors, they'd have the option to maybe cut interest rates, right? If this was a situation from their own policy, but it's not. And so in cutting interest rates, they would arguably make that debt even harder to service, because those exchange rates would become less favorable. The dollar would grow even more against their currencies. And so it's interesting that the Fed kind of helped to solidify this cutting cycle with their aggressive initial volley into this, right? 100 bips in not too many months. But that isn't something that I think was a good policy decision. And at the time, I was pretty critical of it. I remain critical of it because I think it's for all the wrong reasons. I do think one of those was, like you said, trying to make the U.S. debt service cost more palpable, and it ended up having the opposite effect. But I think
the
that's
yields,
because
didn't the yields, correct me if I'm wrong, the yields initially on the 10-year, they went down substantially, right? They hit 3.8 when the Fed started the rate cuts 4 or 5 months ago, and then now they're spiked back up. They were almost 4.8 a couple days ago. They were at 4.8. I think they're down to 4.6, but that's still on the higher end of a range.
Yeah, and it's funny because if you look at the range on the 10-year, and everything you said is spot on in terms of your timing and your recollection. If you look at the range of the 10-year and its average level going back to 1790, I saw a really cool chart recently that showed that level was 4.75. So folks that are like, oh, this is a very high interest rate. And the one way in that post-ZERP world we live in, where we're no longer in zero-bound interest rates, where, everything's kind of been able to go back to something vaguely resembling equilibrium, it may seem high in contrast. But on the other side of it, we're just closer to long-term averages on a lot of these interest rates. And that's the other thing that's very interesting about all of it, because it does enable folks to be able to get a return again. I mean, remember for how long you go to the bank and take out a savings account, you get like a penny of yield on a pretty good balance. Now you can actually, get CDs and other kinds of short-term interest rate products that actually pay a decent amount without taking risk. So in that way, it's good. But because we have a country with so many companies and households in debt, it's not necessarily ideal for them. Although arguably balance sheets are better than they were, say, before the 2007, 2008, kind of debacle that we got into with disorderly deleveraging across the board. But I would just say that I think that right now, one of the things that a lot of households are concerned about is just how much uncertainty there is moving forward. We don't know what a lot of these sort of moving pieces are going to take shape. People are still concerned about prices moving higher. The University of Michigan survey showed a pretty good amount of that concern. The New York Fed survey, which is broader, arguably, didn't show the same lack of anchored long-term inflation expectations. But I would say that just sort of anecdotally speaking, I think more people are concerned about long-run impacts of different policy decisions on just their ability to provide. And then on the other side of it, that AI disruption that's happening and will eventually start to kind of have a bigger effect on the US job market, what that means for a lot of those white-collar jobs and a lot of those sort of redundant jobs that otherwise with advanced technology may not need to exist the same way they do now.
I was actually going to ask about that. So you just transitioned into the next segment I wanted to ask you about was about this capital expenditure that your Amazons, your Google or Alphabet, Microsoft, Meta, they seem committed. OpenAI, now that they're publicly, they're not publicly traded yet. They're for profit. XAI with Elon Musk. They all seem committed to investing enormous capital expenditure into building out data centers, investing in new artificial intelligence. Do you think that we're going to start to see a slowdown in that? Because Microsoft announced, I think a couple months ago, they're going to spend $80 billion just by themselves for 2025, and most of it's going towards data centers and artificial intelligence, quantum computing. Or do you think that they're actually going to hit the CapEx numbers, or are we going to start to see a slowdown in that?
I would expect that some of these projections aren't necessarily realized for a variety of reasons. I do think there is a lot of momentum here, but I think it's some pull forward of excitement in terms of the returns, in terms of the projections of build outs, in terms of the growth estimates that may need to be tempered a bit. And we may see that starting in the first half of this year, depending on what these earnings calls look like coming out from tech companies over the next 2 quarters. I personally think that given the constraints we have in the grid, in interconnectivity and bandwidth, in some of the issues we've seen with the Blackwell rollouts, some of these chips are overheating, and there have been some issues with just overall quality and ability to scale at some of these lower sizes for the dies on the chips. I do think that we're going to see probably some hiccups in these plans. Now, Microsoft arguably has the biggest cloud out there of any company because you combine their app ecology like Microsoft 365 with Azure and their other offerings that run in their cloud. And so they still have other reasons to build even outside of AI, right? That sort of digital transformation that's been happening. Part of it is also moving from on-premises equipment into these large globally distributed public clouds like AWS and Microsoft Azure and otherwise. And so some of that growth is coming from there. Some of it is also coming from more people adopting their platforms like OneDrive and Teams and the other Microsoft 365 Office offerings. So all of that's kind of helping to accelerate it. And then they're deeply invested in OpenAI, the company you discussed just a bit earlier, and they're helping to scale that presence. A lot of OpenAI is hosted inside of Azure. There's also different offerings that allow people to tap into those APIs via Azure. So it kind of helps to feed the demand. So I think that when Microsoft, if you go back to their conference calls from quarters past, and I believe analysts have asked this question in one variation or another, what they tend to do is make a projection and then they'll self-adjust based on the realities on the ground. So they do this sort of graduated process of building out their data center infrastructure. They'll say, okay, let's make sure we can secure the land, secure the contracts for power, for bandwidth, for building out the infrastructure inside the data center, for all of the cooling, the water involved, or other kinds of compounds that they may need. And then also, make sure that we can secure the talent that we need to build it out and to run it. And so it goes through many different stages. And at any point, and they kind of emphasize this part on the call, if things are moving at a different speed than what they expect, they can kind of shift their priorities around. So, for example, if this ends up being a year that is better than they thought in terms of demand, they can certainly try to pull that forward where it's realistic. There could be limitations, and there are in many areas, like the availability of power, the availability of water, the availability of bandwidth, the availability of equipment, and things like that. But on the other side of it, if they say, hey, look, things are going more slowly, we're seeing some bigger picture risks, we think we should slow down, then they can also, for any reason, kind of span out that process. And so I think that with a lot of the companies that are the larger cloud presences and data center presences globally, they have a similar process to Microsoft because that's really the only way you can do one of these build outs and not get too caught up if the cycle starts to move against you, particularly if you're using any leverage, right? So I think that we could see them respond if there are headwinds here. And we've already started to see some forming that could give them pause. The Nvidia Blackwell issue has a lot of these same companies we're talking about, the Microsofts, the Alphabets, the Amazons, the Metas, slowing their roll because now they're having to wait longer to get the Blackwell racks that don't have these overheating issues. And some are deciding to go back to the Hopper chips and use those in their build outs. Others are simply delaying their orders until it's ready to ship. So I think that we're already seeing some potential early on. I mean, we're only 2 weeks into the year, basically, and we're already seeing some potential for these delays to happen. Other situations are just the ability to get the power. into that center. I mean, a lot of these ramp up contracts take 5, 7, 10 years to get going from the time the order is placed to the scale that the data center needs. So I think that's another pain point that could cause this ramp up to go a little bit more slowly. And then finally, bandwidth. I mean, I know we can always turn on fiber and continue to scale higher and higher depending on what equipment we put on either end of the fiber. But the fact is that scaling up all of the backbone infrastructure takes a pretty big amount of lifting. And then building out all of that network infrastructure, not everyone can pull off an XAI kind of situation and build out a huge data center in like 6 months or whatever it was. Like, that's not
120
necessarily,
days, I think, actually. Yeah, it was
yeah. So
insane
it's
how.
uncommon. It's uncommon, right? So like that kind of stuff. I would be surprised if we see that be the baseline. I think that's more of the edge case. I think a lot of this stuff could realistically take a little longer than projected.
Yeah, so there's rumors on one of the data center websites. They're reporting with their industry contacts that Meta just purchased, I think, 20 data centers to start construction. But what you're seeing based on what Microsoft does, that could take quite a few years for those 20 data centers to be fully constructed and operational.
Absolutely. It typically, for these larger build outs that are happening, and generally they're globally distributed, there's all sorts of different permits, there's all sorts of different processes that need to go in place to have the buildings certified, to have their interconnects, put on, to get the approval from the power company, the local regional governments, et cetera. It usually takes more than a year. Usually it takes years to really go from, buying the land, having an operational data center that's able to run a training or inference workload, or is hosting content or applications or whatever else it may be doing. So I would just say, we would want to temper our expectations on timescale a little bit for some of the components related to AI and cloud, and how fast this stuff can come into our expectations versus reality.
And these are next generation data centers. These are not data centers for your going online on the internet and either playing video games or live streaming or using Netflix or watching YouTube videos. I mean, we're talking basically an order of magnitude more electricity generation here with using artificial intelligence and computing power. So it's they basically have to build advanced cooling systems. They have to have a lot more reliability for the electricity to run the artificial intelligence learning language model. So it's not the same data center that people are used to now in what the cities with the YouTube and Netflix and live streaming.
It is interesting. They are, I would say, where we are making some presumptions about how will, in the near, intermediate, and long term, make AI accessible and useful to people, because I do think the presumption, the base case is we just need GPUs, as many of them as we can get, ideally Nvidia, so we can use their exclusive CUDA ecosystem and really fast track our workflow. And then we need as much power and as much bandwidth and as much data as we can get our hands on, and hopefully we can build something useful with all that. And that sort of, training and fine tuning, and then making it available for inference, whether it's text or video or audio or picture generation. That's sort of the model right now. But we also know that that's not necessarily the only way that AI will take shape. And also that, using GPUs for every part of the workload in some situations is like throwing a sledgehammer into a situation where you just need a tack hammer or an Allen wrench or something completely different. It uses a ton of power, it produces a ton of heat, and it's not always the most cost efficacious way to get to your goal. So I do think that as time goes on, and even as early as later this year, we're going to start to see some changes in how we build models, in how we train them, in how we infer them, in the kinds of hardware and software that's involved with that. And I believe that eventually that's going to become both more powerful, but also require less aggregate computational power, less raw power, the way it's being used with GPUs, which are sort of becoming a general purpose tool for all things related to training and inference. And in reality, they may not necessarily be the ideal technology for everything all the time. And if that ends up being a larger industry trend, it does change a lot of our assumptions about the amount of power and the amount of cooling and other areas that data center demand could come from for these next gen data centers. So I think it's really interesting, because I do believe there's been a lot of sort of And to this point already, accurate presumptions about what's going to happen with AI and where the demand will be. NVIDIA's got 95% of AI data center GPU market share. That's impressive. They've also once had high 80% margins on their products going back to Hopper. But now that Blackwell is out, it's lower 70s and eventually supposed to become mid to high 70s. But that is a pretty big bump down as they shrink the dies, as they go, I believe, down to 4 and then 3 nanometer. And then hopefully they're able to get to 2 without too much of some of the problems that can happen with electrons kind of shifting lanes the way they're not supposed to. We're starting to get into some of the quantum mechanics that can interfere with the ultimate ability to really innovate on a single chip. We're getting very close to that point. We're already there to some degree with quantum tunneling and some of the other problems we're having at like 3 nanometer scale. So I think it's a long-winded way of saying, this GPU tech has come a long way. It's very powerful, but it may not be the end all be all. It may not be the best for every use case. And that may be a good thing for innovation, because if a company's earning 75% margins on AI semiconductors when other companies are selling ostensibly the same or better hardware without the software ecosystem and some of the network ecosystem and other parts to power it, but they still have superior products with a much lower buy-in price. And
It sounds very inefficient, but you said that Nvidia has the main market share. Now, I saw on a PC World podcast they were talking about Nvidia chips, what, 40,000 or 50,000 per Blackwell chip now, very very high price. But it sounds like the best thing about capitalism and free markets, when there is a first mover like Nvidia and they come out with this innovation, they charge a high price. I mean, that's the incentive for competition to say we want to take their market share. We want to innovate. We'll come out with a better product, maybe that's cheaper, offered at a lower price point. Do you think we're going to start to see that with maybe like AMD and Taiwan Semiconductor and Broadcom and Qualcomm and some of the other competitors soon?
I mean, I think they on the hardware side, they already have been doing that. It's impressive what AMD's MI series of AI GPUs has been able to accomplish, versus Hopper. They had a more sophisticated, faster card with more memory on board at like half the price. And the reason that it doesn't get the same kind of adoption is it doesn't have that NVIDIA exclusive CUDA ecology, the software ecosystem that allows a lot of these AI workflows to be much, much easier, much broader support for training, for inference, for applications, for middleware. And unfortunately, that's helped to really accelerate NVIDIA getting that 95% market share. Yes, there's been amazing innovation. I mean, CUDA is something they started in 2006, so they deserve to have that moat to some degree. But when it's allowed there to be such a big markup of product, such that it actually does stifle global innovation in AI, that's an issue, and it is something that governments around the world, including, and we'll see how that changes with administrations, but the US has started to look into it. The EU has started to look into it. China, for what it's worth, which is probably just part of the trade warring, but they've said they're starting to look into NVIDIA's anti-competitive practices. And I think that of all of those, the most likely that could take some action, because they continue to do this against big tech, is the EU. And the action that could be one that actually helps to, I would say, hasten in innovation in AI would be if they opened up CUDA to AMD, Intel, Broadcom, Qualcomm, and other competitors of NVIDIA, and allowed a diverse array of hardware that's buy-in price is much lower, but still has similar and sometimes better features at lower prices to compete in that same ecology. Obviously, that would be detrimental to NVIDIA and their investors in the sense that their margins would be compressed, their revenue growth would slow, maybe even drop a bit. But at the end of the day, it would be much better for the rate of innovation and the cost to access that innovation for everyone downstream in AI. And it was funny, and the reason I bring this up, I don't want to chide NVIDIA too hard, but the Biden administration was going and now has implemented further restrictions on the sales of NVIDIA chips to other countries. They've created these 3 different grades as to what they're allowed to sell based on this grading system to different trade partners around the world. And what's interesting about this is NVIDIA's response was, this is very anti-competitive, this stifles innovation. And I immediately thought, but what really stifles innovation is gatekeeping these products behind a proprietary ecology And the reason I say that this gatekeeping is every time someone comes up with an abstraction layer to try to let other hardware work inside of CUDA, NVIDIA smacks them down with cease and desists and threats of lawsuits and otherwise. So there's been attempts to bring on AMD and Intel and other hardware into CUDA, or at least being able to run CUDA code, and those have been smacked down. So that's a little bit anti-competitive. Yes, you can make the argument it's their IP and they're in the legal right, but at the same time, when you have 95% market share and your margins are predicated on that sort of behavior, it does argue how much is that stifling innovation? Is that for the greater good? And I think that's why we start to see these governments around the world looking into it. So, the long story short, it's a left tail to look out for maybe this year or next for Nvidia. But net in the aftermath of something like that, should it happen, it would actually be good for the overall cost of getting involved with AI as it exists today, the sort of LLM centric AI, because we know all AI doesn't run on NVIDIA. We just sort of, have been focused myopically on that as this company becomes one of the biggest companies in the world and a tremendous run. But at the other end of it, you do have companies like Palantir, and they're not huge users of NVIDIA chips, and yet they do have very impressive big data and AI and analytical and automation capabilities that they're able to roll out at scale. So I would say that, we're going to see AI take a variety of paths. Some of them are going to surprise and delight us. Some of them are going to come from left field. Some of them are going to be not so pleasant. But at the end of the day, it's here to stay, and it is going to get better and better. We've just pulled forward a lot of the excitement and returns into the present, and that's a big risk in the space.
Okay, so by returns, you mean the stock price valuations on anything named artificial intelligence or quantum computing. It's like risk on. People are gambling on these shares, and they drove them ahead. I mean, you posted this on your X, that there was actually a quantum computing company, I think here in Northern Virginia, DC metro area, I think Maryland maybe, and it wasn't even a quantum computing a month or two ago. It was a shell company of a different company, and then because this other company changed their name to quantum computing or something, their share price went up. But it's really just an office with business cards. They don't have anything there.
Yeah, so there's a company called Quantum Computing Inc. I believe it was maybe several years ago. They bought a beverage company and basically used that as a way to sort of, like the SPACs used to do, get easier access to capital markets rather than going through their own IPO, because they would presume that any real scrutiny of this company would determine that it is simply a shell company and just a speculative, long duration growth risk stock, generously speaking, and maybe something much different, allegedly, maybe something much more resembling a gross misrepresentation of what they actually do. So there was that post on X. Someone had visited their office. I do believe you're right. I'm just looking it up here now. Yeah, they're
It reminded me of Wolf of Wall Street, the movie, where he was selling like these tiny little small cap companies, Jordan Belfort was, and basically like the actual company, the assets, there wasn't a business. The assets were like, it was a shack, and it was like an office, saying quantum computing in an office park. For our listeners out there, if you want to research quantum computing a little bit, there was a mini documentary on 60 Minutes about a year ago, and they actually allowed the reporters and the video journalists to go into what one of the Microsoft quantum computing. These things are very, very expensive to even build a test one.
Yeah, they are. And it's actually an incredibly cost intensive endeavor with no guarantee of future returns. So it's not something you build a business on that's going to be highly speculative, unless as investors, you're perfectly okay with just setting your money on fire in hopes of a lottery ticket playing out. Like, this is like a basically taking a call option, because even if you don't think there's time decay, there is, because the company only has so much cash, and then eventually they'll just start diluting their investors.
Well,
So
you could buy Microsoft or Google, and they have profits from other businesses, and they can
right.
use some of those profits to fund, let's say, artificial intelligence advancements or quantum computing. So you still get a business that generates because Microsoft can use profits from Microsoft Office and some of their other stuff. Their OneDrive, if you're charging for hard drive space in the cloud, they can take those profitable businesses and use some of that research profits for research and development on those projects, like you said.
Yeah, exactly. So, I mean, with more established companies that actually have business models and actually have profits and, business engines that are firing on all cylinders, this is something that they can continue to invest in, and they should, as are a lot of the other sort of forward looking technologies. But when you talk about pure plays in the space, that's where maybe one of 10 will exist in 10 years from now if you're lucky. That's the concern I have. I think a lot of these companies are essentially lottery tickets or call options with decay at variable rates, because you don't know if they're ever going to become profitable, if they're ever going to make a working quantum computer. Now, I think the companies in the space that do succeed will probably be the ones that create something of some value in their research that they can license as IP, whether it's patents or specific knowledge or ways to accelerate quantum computing's development or improve its error correction or reduce error rates. Those are sort of things that maybe some of these firms are able to build and license out to the bigger players without building their own quantum computer. So that's probably your best case. Maybe one gets really, really spectacularly lucky and builds some early quantum computing that can be, constructive for them to be bought out by a larger company to accelerate their own research. That's another potential bull case. But outside of those sort of outlier scenarios, I do think there's a lot of somewhat dangerous speculative froth in this space. And unfortunately, some of these companies could be outright zeros when all is said and done.
Yeah, I agree. I mean, I don't even think they have any quantum computing testing. It's that expensive. So it sounds like just a marketing gimmick, like something like when Kodak added crypto or Bitcoin to its name. It sounds like kind of a marketing gimmick where this someone bought a shell company, changed its name to quantum computing because that was the hot topic. But to actually do quantum computing, you basically have to be backed by the U.S. military, the Pentagon, a military industrial complex company. You have to have contracts with someone like Palantir, who has these U.S. military or military industrial complex contracts there, to where they have a profitable business, and then they could get funding and they could do advanced research, on artificial intelligence and quantum computing, or you actually have your own business where you can reinvest in other profits into more developmental projects like Google or Microsoft.
Right. I mean, just the other day, the CEO of Rigetti Computing, which is apparently another one of these, highly speculative quantum companies, they're even being very forthright saying that we really need to tamp down expectations. So the quote is, particularly because of the hype that is going on in the quantum computing space and some errant statements are being made, including by people in the industry, we have to tamp down some expectations, specifically that sales and sales growth are very much a future looking prospect because the technology is still in development mode, which is a very polite way of a CEO saying, we're nowhere close to even realizing commitment of capital from clients. We're nowhere close to having anything we can sell.
Is that like pre-revenue from like the tech bubble? How like,
Yeah.
oh, we're pre-revenue, oh, we're just building a website for clicks or something.
Yeah, we're pre-revenue. We've got the .com on our name. I mean, that's pretty much where we are, and we see that in some of the other spaces as well. There's certainly a lot of companies trying to claim they're more into AI than they really are to excite investors. There's companies that are trying to, claim that they've got the next revolution happening in robotics or in self-driving or otherwise. I mean, at the end of the day, a lot of these things are going to become very real parts of our society, but they're further off in the future than what investor excitement and prices would suggest. And I think that's, the sort of bifurcation of reality versus expectations. There's a lot of folks that are justifiably excited about this stuff, and they should be. There's a lot of really cool stuff that's going to happen in our lifetime, but it's not going to happen all this year. And it's kind of priced like it is. And I think that's one of the things that has me concerned, particularly on the really speculative parts of the market. But even in some of the larger tech companies, there's a lot of froth out there. And we're likely to see some slower growth trends, particularly at Nvidia. We're seeing that at places like Tesla. We're seeing slower growth in the cloud at Microsoft and Amazon. We're seeing headwinds kind of forming in those really big double-digit growth numbers that they had been posting. And I think that on the other side of it, going back to our conversation about this is kind of the boom part of the cycle, if that's true, And especially if there's some exogenous catalysts that come into the big picture, stimulus, from China could be one of them. Maybe the Trump administration's able to get through some tax cuts or some other kinds of spend that juices the economy more. If you see that feed into the boom cycle, I think the other part of it, and deregulation arguably too, could help the older economy part of the stock market that's largely been left behind for the last 2 years or so. Talking oil, we're talking gas, we're talking materials, metals and mining, industrials. I do think there's room for that other part of the market to come back this year. And I think that that rotation has already been underway for several months and is starting to intensify in the last several weeks. So we're already seeing larger investors kind of positioning for that, lightening up in tech and various aggregates, whether you're looking at positioning, flows, performance, relative strength, relative weakness, suggests that that's a rotation that's underway, that's intensifying. That momentum, that transition seems to be happening. Obviously, earnings season will be somewhat decisive about future looking expectations for these relative strength, relative weakness kind of trades that are setting up. But I do think that overall, this is a year where it's going to be a little bit different than 2024 in terms of what leads the market. I don't think it's going to be big tech as much. I think there's still room for some of these growth narratives to play out, but it's going to be much more of a show me story this year. And we started to hear whispers of that last year. And what I mean is, okay, great. You're spending all this money on AI. You're spending tens of billions of dollars on this and that. Is it going to make returns soon? And if it's not, I think investors are going to get a little less patient because they've been wanting to see the CAPEX translate into profits in subsequent quarters. And of yet, it's only really at the margins. It's not really benefiting as much as like we're not really seeing an ROI yet. We're still kind of in the red on that CAPEX for the majority of companies out there.
Yeah, I agree. I mean, Palantir stock is up a lot. I think in the last 10 months or so, it's up like 5x or something like that. It's up a lot in under a year. But I see comments from people who tried to read their financial statements and they can't understand the different businesses Palantir has or how they make money. Now, I think a lot of that is because they have top secret security clearances. They have contracts with the Pentagon, U.S. military, U.S. intelligence agencies. They have contracts with military industrial complex companies, so they can't disclose everything. But from what I've heard, anecdotally, that they are getting a lot of funding for artificial intelligence and supercomputing and things like that.
They are, and they also have, so outside of their government work, they also have a platform called Foundry. So Gotham is what allows Palantir to interface with their government clients. It's a way of optimizing the flows of intelligence, being able to gain real-time insights that can help to save innocent lives, that can help to target, enemies or get intel that can save our assets overseas. It has a whole myriad of capabilities for combing through different types of signals intelligence and human intelligence and geospatial intelligence, and really becomes invaluable in the battlefield, but also just in kind of keeping the peace in an ever more, I would say, volatile world. And so there's a lot more demand for that from our allies, and they'll only sell to our allies. They won't do business with China. They won't do business with a lot of these repressive regimes in other countries. So, they also kind of have like an affinity for and a requirement to do business with Western or Western friendly governments, which is another big part of the company. But outside of Gotham, they have a platform called Foundry, which is a data analytics, automation, AI platform that helps Palantir provide invaluable assistance for companies in their digital transformation. So if you're a big company and you've got your customer relationship management, you've got your transactions, you've got your inventory, all in different data silos, they can help to bring all that information together, gain real-time insights that can help companies to streamline how they manage their inventory, their customers, gain additional sales, improve productivity, improve margins, reduce waste. And you can see that even in other industries like oil services, where you might be able to get ahead of failures on a rig because you can use predictive analytics to say, you should do preventive maintenance now to get ahead of a potential failure. Getting ahead of that potential failure reduces downtime. It also improves revenue because you've got more product you're producing. So it's sort of like we're seeing a lot of use cases for this type of AI that originally was more built for Gotham and how it
It
helped the government and the military now apply to the corporate use cases in improving productivity and accelerating digital transformation.
Mayhem, it sounds like multiple technologies are being stacked here. So it's taking big data, it's taking analytics, it's combining it with artificial intelligence, and it's producing productivity gains where the humans can be more productive. You don't need as many humans employed, but the humans who learn how to use this software, the productivity software better, are going to get rewarded by the company then.
Yeah, and you'll see companies be able to do more with their existing infrastructure. You may even see the software create demand for more jobs because you may see companies gain such productivity and such increases in their ability to do workflow that allows them to scale, become more profitable, do a better job for their customers, hire more people. Like there's a lot of really good use cases. And the cool thing about it is once you have competitors in a certain industry starting to take on these types of platforms and Palantir's Foundry especially, that starts to change the dynamic because then if you're not using it, you're left behind. And so you have to either go with one of their competitors or go with Palantir directly or figure out your own in-house solution. Good luck there, by the way, catching up to the amount of innovation that's already happened in this space. So it creates that dynamic where it becomes like a flywheel, getting more and more folks on board. And so Palantir's biggest weakness became their biggest strength in 2022. Their biggest weakness was their commercial offering was something they didn't really do a good job advertising. They didn't do a good job selling. They didn't really have that customer facing mechanism that they needed. And in August of 2022, when all these other tech companies were firing tons of talent, Palantir went out there and did an aggressive hiring spree. And they also started, so they were building their tech brain share, but they also started really building their sales and marketing arm out for the corporate side. And that had been up to that point a terrible weakness for the company. It was reflected in the price of the stock, and it really pissed off a lot of investors that they were, buying these SPACs and investing in them and not really building out sales and marketing. And it seemed like they had this sort of managerial naivety that they didn't understand the process of selling to companies. Well, they were a quick study. Maybe they use their own software, but they were a quick study. They learned how to turn that around and they built an incredibly effective sales and marketing arm that I would argue is using their software to optimize the efficacy of that lead conversion pipeline on, building these long relationships because getting onto Foundry takes a lot of work. It's a process that involves, a group of engineers. It involves getting all of your data online, all your systems connected. It takes months. It costs a lot of money. So it's not like you can just walk into a room, hand someone, a one pager, and they can just sign up on a website with a monthly subscription. It's a very involved process, which means it also involves a lot of work to sell that, a lot of contact, a lot of pre-sales, a lot of delivery engineering talk, even before you sign a contract or make any money. So there's a lot of overhead there. And they figured that out. And that's an impressive feat that they're able to scale their commercial revenue double digits reliably, quarter after quarter after quarter, and still see that growth trajectory ahead. And if you think about how much they've kind of broken into that space and what the market share they've built versus what is to come in the next 10 years, they've barely kind of scratched the surface of what's potentially going to happen with the ability of Foundry to really disrupt and improve the ability of companies to actionably take all that data that usually just sits around collecting dust, or occasionally they run these esoteric analytics on it that don't really gain a much actionable intel, and turn it into actionable intel that can improve productivity, improve the bottom line, lower failure rates. This is all the kind of stuff that is misunderstood about this business. A lot of folks kind of think they're just a one-trick pony, but the reality is they keep building new platforms, new offerings, differentiated ways of facing new markets. And then now, with the way they've transitioned their sales and marketing, are actually becoming incredibly efficient at entering those new markets successfully. So on the one hand, I'd say the stock trades at an insane premium. So I would hope they're able to grow into this valuation by continuing to deliver incredible growth. But there is a possibility of, some consolidation and volatility like we've been seeing, or maybe even a bigger correction than what's happened to kind of get it more into a realistic valuation. So we'll see what the next quarter, the earnings report and the conference and the guidance brings us. But I'd say long term, this is a company I'm very optimistic about. It's one I've owned since the single digits in price. I bought at IPO and I've been building into that position into weakness because I still believe in the management. I did have a moment where I kind of questioned them, but then when they started hiring folks in August 22, I was like, you know what? They have a vision here and they're finally realizing how they can achieve it by building out that sales and marketing team that they needed. And they, during a time where a lot of folks were firing in tech and terminating contracts with vendors, they started showing corporate growth in that part of their clients. And that just started becoming that flywheel of engine of growth on the corporate side. While on the government side, they were also executing pretty well, albeit with more lumpy billables because of those longer term contracts. So this is one to keep on the watch list as a real AI company and one that's not reliant on those incredibly expensive, if not overpriced GPUs to do all of these workloads.
It sounds like they were contrarian and counter-cyclical in 2022, that they were investing and adding personnel that the other companies were firing. So they were questioned at the time, but a couple of years later, the management's bets paid off, and now the share price is, it's re-rated. Obviously, the stock price is up a lot. The fundamentals of the company, the turnaround, are what started to drive the underlying fundamentals, the growth of the company with the revenue growth and the profits is started to drive the share price, and now you have what the valuation is frothy. I want to ask you though about 2025 for artificial intelligence agents, some companies that might be profitable. We're starting to see some of these fast food companies roll out, like I guess like on the touch screens or you drive through, artificial intelligence ordering systems instead of human beings. We're hearing about a customer service company like Walmart or some of the other customers that use a lot of customer service in the Philippines or India. They're switching to artificial intelligence programs like AI agents. Do you think that those types of companies will be profitable, or do you think that we're still ways off from any artificial intelligence being profitable for anyone?
I think that the more simplistic kind of things, like we were talking before the interview about SoundHound licensing out some of their, speech to text abilities to place orders at a drive-through. That's fine. That's simple tech. We've had Dragon naturally speaking for 20, 30 years, taking that voice to text and then adding a couple of features so that it's able to then turn that into an order, confirm it with the customer, maybe read it back with, text to speech. That stuff is basically basics in tech, kind of bread and butter kind of tech. And I think that stuff can ramp up and, it can be profitable for the folks that are licensing it. And it can help to improve margins that the company's using it, because obviously you're going to need less cashiers. You're going to need less folks processing orders. You've got companies like Toast that where you go to a restaurant, and I'm sure you've seen this, you'll go in and you'll just place your own order. There's no one at the cash register. You'll swipe your card. Maybe someone from the kitchen comes in, delivers your food. Like there's less people working there as a result of having these types of things. You can do the same thing online with Toast. So it's not even necessarily AI as much as sort of like tech focus and automation that is also part of this trend. Now, when we start talking more about the chatbots and in particular things like large language models, I do think that there's both cause for optimism, but also room for pausing just how much optimism we have and how near term we think some of these things are going to come to fruition. I do think that large language models are impressive for certain use cases, but they have very serious limitations in the here and now. And so for the one side of it, if you're going to be trying to accelerate how quickly you can code an application, getting the input of a specialized large language model that can give you feedback in the form of programming that maybe completes a line of text or helps you to optimize performance or security or helps you to troubleshoot issues you're running into, that can be invaluable. It's kind of like having a junior engineer, right? But when you start talking about more advanced use cases or higher levels of creativity or accuracy being important, like if it's replacing a writer, that is where I think there are remaining many important issues that have yet to be resolved. And we've talked about retrieval augmented generation, where language learning models may be pulling from a different source, whether it's a trusted document or database or search engine of the web, to fact check essentially what they're saying, what they're inferring from this multiplication matrix of inferred relationships. That's what the training of AI models is. It's really, they're building these big inference engines that are instances of multiplication matrices of inferred relationships. And that's why it's called inference between words and phrases and numbers and other concepts. And so when we're talking to one of these LLMs, it doesn't understand what we're telling it any more than it understands what it's saying to us. And so that's one of the issues. There's really a lack of reasoning. There's a lack of cognition. There's a lack of self-awareness that, we're getting better. There are models that are doing more reasoning. There is more attempts to mimic some of that basic cognition and reasoning capabilities in these transformer models that are often what these chatbots are built on. But it's still very much in its earlier stages. They still have a number of different, I would say, issues for being able to reliably use for a number of the different use cases that people are getting a little bit more excited about in the here and now than maybe we should be. So on the one hand, I'd say, yeah, it's really cool that I can fire up a LLM and I can use retrieval augmented generation to make sure that it's not hallucinating its output. And I can make sure that it's getting something that's likely true. But it's also kind of sad that this was supposed to be a step forward in the ability to interact with large volumes of information. And it's so unreliable in its current iteration of technological progress that it has to retrieve data from a third party, whether a document, a database, or a search engine or otherwise, to know whether what it's telling you is in any way accurate, because it doesn't know what it's telling you. It doesn't know what's true or false. And so that inference can become errant. And the only way to correct for that we know is to cross compare against other sources of data, which to me feels like a step backwards. If anything,
So you're running what you mean is, let me simplify this. You're running the learning language model a bunch of times to check to see if it's coming up with like insanely dumb answers or incorrect answers. It sounds inefficient. And then you have to run the LLMs a number of different times. I think like 5 or 6 or something like that. They were on average for some of the queries that a human being can answer really quickly. And that's a waste of what, electricity too?
And so it would be a waste of electricity and water. And so what, retrieval augmented generation hopes to do is stop with the repeated queries and the drop in confidence about the answers that the end users are experiencing with all these hallucinations, and be able to query a source and then retrieve that, compare it against its answer, and make sure its answer is correct. So that's a really kind of fancy way of saying the AI is going to essentially search Google to make sure what it's telling you is the truth. But if the whole idea of this stuff was to replace conventional search engines, and it just becomes an abstraction layer with a chatbot over something that resembles a traditional search engine, how far forward are we really coming? So look, on the one hand, I think there's room for optimism. I do think we're moving forward and there's a promising future for this stuff. And I think it will have more and more use cases for diagnostics, for interpreting large volumes of data, for translation, for, navigating through complex legal documents and all sorts of other stuff, medical diagnostics, drug discovery. There's a lot of use cases, but I do think we're also pricing in far more optimism about where in the timeline those use cases are going to become profitable versus realistically where that's going to occur with some of the limitations we're seeing in the hardware and in the software. And I'll add one other nugget to that. And this is a really important piece. In fact, it can't be understated how important it is. You'll notice a lot of these models don't have training data after 21 or 22. That is because most of the web became so contaminated with LLM generated content after that time period. That's sort of like the after the death of the internet, dead internet theory that there's more bots than people creating content. It happened. And as a result, the content is so thoroughly, you could say, polluted, tainted, whatever you want to use as an adjective, that you can't train AI LLMs on it anymore because it'll dilute their efficacy, it'll pollute their content, it'll reduce the accuracy of their inference because it's taking all this other content that other AIs generated. So now we're at a point where these companies are looking for other ways to get verifiable human content. So they're being more aggressive, scooping up copyrighted content from authors, from books, from movies, from YouTube videos, from social media websites, licensing out content like Google did from Reddit as one place to try to comb through what they assume is human generated content. But this is the shortage, the new oil rush in this whole training space for any new and novel data is data that can be verified as human generated, and it often involves them either behaving as pirates or making relationships with sites that are huge aggregators of this data for one reason or another and training off of it. And that's one reason why XAI in some ways is maybe a bit of a stroke of genius, depending on how many bots versus people you think are on Twitter. But they have that huge data set that they can train off of for all the presumed human users. And that's certainly an accelerant for whatever they hope to build there. Google has that as well with the fire hose access they've had to Twitter, which continues now into X. But at the end of the day, the lack of enough new, verifiably human generated data is a huge bottleneck. And it's a big ceiling above where AI can go from where it is right now. And the longer that we're not able to readily qualify what is and isn't AI generated or have larger volumes of data to train this stuff on, the further dated its knowledge base starts to become, which is another reason retrieval augmented generation is important, for it to be able to check what it knows versus what all has happened since.
Well, the artificial intelligence generated data, the synthetic stuff, I mean, it looks, some of it's highly inaccurate. I mean, isn't it like it's gender bending people? It's interpreting history incorrectly. Didn't it like it made George Washington, like someone asked it to produce pictures of the American forefathers and it made them like LGBTQ, and a few of them were black. Like it was like, it was just, didn't Google fix it? It was Gemini. I think it was Gemini.
Yes, it was Gemini from Google, and it's probably been one of the bigger black eyes on the company because Google was for quite a while in many ways a leader in AI, and then somehow they really slipped. They've been making a bit of a comeback. I wouldn't count them out quite yet, but I do think that the issues they experienced early on also showed a lot of a concern about a whole other area, and that's the amount of bias that we see in AI and the way the data is trained, the way that it's, sort of sanitized, the way that they create these guardrails on inference. Often is the case, it can go completely off the rails in ways that you really, really don't want that data to go. And we saw that firsthand there. Also, someone asked a question that was related to astronomy, and it completely flubbed the question. It was a pretty simple one for, an AI to be able to answer. So I do think that there are a lot of limitations. This is another reason, by the way, why that retrieval augmented generation has become more pivotal, because more and more, the engineers are realizing, look, there's no way that this stuff can operate on its own with its own data set. The more that you train it on different tokens and variables, and you're getting data sets now in the trillions of different variables, the more accurate it can become, right? But then on the other side of it, you need hundreds of thousands of GPUs and a huge mesh of virtual, interconnectivity between all of them to essentially create a cohesive large language learning model training system and inference system, right? Because if you have that much, like you're going to need like a terabyte of RAM or something to run a high bit version of that model. That's not something you can do on an everyday computer. A lot of people are self-hosting AI, but that's also not something that you can lease out for a monthly service for anything where you're going to be profitable unless you're charging an enormous amount per month. So like the higher quality AI is so resource intensive. And you sent me a link the other day about how OpenAI's monthly service isn't even profitable at $200 a month because users are using more of the service than they're able to make $200 a month revenue go towards. So it ends up even being a loss leader even at that price point.
Yeah, I'd like to. They're not publicly traded yet. I'd like to see their power bill,
Yeah.
what their power costs are. I mean, like if they're losing, it sounds like they're losing money at $200 a month for Chat GPT Premium, whatever number that is. So what you're gonna see a price increase then soon.
I would think that they're going to try to either build out in the sort of Bezosian philosophy of your margin is my opportunity for as long as they're able to, or they're going to try to get a little bit more aggressive about realizing some of their ambitions with partnerships and corporate licensing and kind of being part of the mix in some of these AI applications where middleware sits on top of their engine. Because I don't think the direct consumer facing stuff is going to be profitable anytime soon. And even some of the direct business facing elements that they offer, again, they're going to have some trouble becoming profitable with that. So their best bet is to try to capture as much of the market share as they can over the years ahead versus Claude and some of the other competition that they have, because this stuff is going to become more and more commoditized, more and more, the at home computing capabilities, the ability to spin up your own cloud with GPUs, or go to some of these other providers like Hugging Face or DeepSeek or otherwise and get that experience for free or for a very low cost is becoming easier and easier. Like for my computer right now, I've got two video cards, I've got 24 gigs of video memory. I can run these 32 billion parameter models just fine. And a lot of the output is on point with what OpenAI offers. In some cases, it's a bit better. In some cases, it's a bit worse. But at the end of the day, why would I pay $200 a month when I can have unlimited queries, on my own computer? So the other side of it is, it's like you've got folks that are a little bit more knowledgeable about tech, and it's becoming easier and easier to just self-host your AI unless it's an incredibly sophisticated model. And you're really not getting anything that's worth that at $200 a month. So you start to wonder, at what point does this become a greater concern that this isn't something that is necessarily worth the money that's being charged and they can't even profit at that price?
And plus, like a lot of these companies that are not public yet, they're raising capital at insane valuations. I think I just saw another competitor to OpenAI, I think $60 billion valuation capital raise. So you're seeing a lot of capital raises of this. It's just we're in the early stages. 4, 5, 6 years ago, artificial intelligence was looked at as a joke. There was not many progresses, I think, until Google in 2018. And then over the last 5 or 6 years, there's been some really huge advances. We're going to hit a bottleneck, though, because it sounds over the last 45, 50 minutes, Mayhem, that you've described, it's very inefficient. We made some gains here, but now we've hit a huge bottleneck. We're wasting tons of electricity. The big technology companies and the U.S. military, Chinese military have to spend an insane amount on supercomputing and some of the other resources involved. And then a lot of the companies that are spending this capital expenditure, they're not justifying to their own shareholders that they're getting any type of profits for this. So it sounds like the capital expenditure will slow down unless there's some type of profit potential in the next year or two.
That's what I think investors want to see. I mean, and look, if we were investing large amounts of capital in this stuff and the companies we were investing in weren't able to show us the path to profitability in terms of a timeline, in terms of any surety, we'd start to become a little skittish too. Granted, like you said, Microsoft and Google and these other companies, they have plenty of other components of their business to offset this capex. But at a certain point, investors also punish companies for not being efficient with capital and reward companies for being efficient with their capital, because ultimately that's what it's all about, right? You're really trying to make sure that your money is treated well and capital will go to where it's treated well. So I think that, we could see a bit of a show me story emerge in this earnings season and in the next earnings season ahead of it, where it becomes more important for companies to be able to demonstrate that, yeah, we're spending money on AI and it is becoming actionable for us to be able to monetize it and become profitable pipelines that exceed the amount of money we spent on it. If we start seeing more and more of that, then that's great. That solidifies the, sort of pull forward of future returns. It still means you could see subdued returns in the future because of that pull forward, but companies can grow into their valuations and then continue their scaling process as they do and eventually bring some more returns to investors. But on the other side of it, if we do see any hiccups, if we do see any anti-competitive enforcement against a company like Nvidia, or if we do see any hiccups in that large data center CAPEX, or if we do see more scrutiny of using people's copyrighted works without their permission to train for-profit AI models, or if we do see a change in what's used for training, what kind of hardware, what kind of silicon for training and inference, there's a lot of different things that could be disruptive. Ultimately, many of them would be very good. But in the near term, they could be volatile. They could be catalysts for underlying shifts for where companies are spending money, how that's realized downstream to some of the beneficiaries, how that impacts customers and their costs for getting involved in the space. So I'd say this should be a year of innovation, transition, and really seeing how some of this technology takes shape, where the real path to profitability exists in companies like Palantir that are arguably already very profitable from their AI and putting tons of money into making it better and better and better versus other companies like OpenAI and others in the space that may be nowhere near a path to profitability. And sure, they could go IPO and they could raise money from the public markets, but they may not, without really finding use cases that they can scale, that can become much more profitable pipelines, be able to achieve that same kind of path to success and sort of future returns that companies that are already there and executing can. And I think the other big question is going to be, really, does Nvidia remain the leader in this space? And I think that is a big question mark if we're looking out 3, 5, 10 years. I think right now, arguably, they are. But looking forward, that can change, because it's not that their tech is better. It's that it has this exclusive ecology that they've been building around it in the software, in the networking, in some of the other parts of its ecosystem that lock in customers. But if you did see anti-competitive action there taking place from like the EU forcing other companies to be able to allow them to use CUDA, that could change the entire ecosystem to the betterment of customers in this space, because they realize lower costs, they get more compute, they'd be able to accelerate their innovation, they'd be able to determine whether what they're doing is worth anything earlier because they'd have more compute. A lot of these outcomes get pulled forward. But on the other side, it wouldn't be good for Nvidia or its shareholders during that period of transition. It'd be better for the competitors that would realize some gains, like the AMDs, God forbid, the Intels, also the Broadcoms, the Qualcomms, things like that. So I think that this is going to be a year where we see a lot of shifting themes, and it's exciting because we don't know exactly what lays ahead of us. All we can know is that there's a number of different tail risks that could kind of undermine the story. It's already priced at a premium all over the space. And yet there's another number of attractive investment opportunities in some of these other parts of the market, of the global economy and domestic economy, that could be really attractive, like commodities, like energy, gas, oil, materials, metals and mining, industrials. So in my opinion, and also even parts of cybersecurity, arguably there's still plenty of parts, even in the hack ETF itself, that are well priced and worth gaining some exposure to in an environment where we'll probably see more record-breaking breaches. So I think that it's still a year full of opportunity. We just maybe need to shift our focus a little bit away from the Mag 7 and all the concentration risk that provides, and maybe look more towards things like RSP for equal weight exposure, in the S&P, maybe QQQE for equal weight tech exposure, the NASDAQ, maybe things like VTI for global market exposure if we want to diversify a little bit. But I'd also look more into XLE, XOP, XLI. I'd be looking at XME, all those sorts of areas that have been neglected and beaten down, where ESG has also turned a lot of investors away, and the ESG movement is finally starting to die. And that's going to be great for all these older economy companies, as is the sort of anti-regulation atmosphere we're going into. So I see it as a year of opportunity, a year of transition, and a year that's going to be exciting. Fair amount of volatility, I think, will come this year as well. But that's good for us that are either traders or investors, because volatility can work in our favor if we take advantage.
I think there's a new ETF that's being launched that's like either anti-ESG or anti-DEI. I can't remember. I can't remember which one. Last question before I let you go, and you kind of touched on this in the last minute or two about commodities and gold. The gold price right now in US dollars, it's been above 2,600 now for months. Anytime it's gone below 2,600, it's rallied. It's above 2,700 today. Are you surprised that the gold price is consolidating, building a base in spite of a stronger dollar, in spite of an attractive U.S. Treasury yield on the 10-year U.S. Treasury? Does this signal then that the gold price is building a base and that we're going to see the gold price way above $3,000 18 months from now?
So I would say a couple things. My outlook for the first half of 2025 is a gold price of $3,000 an ounce. And I think that that becomes much more likely with the kind of policy uncertainty, geopolitical uncertainty, and just overall economic uncertainty that we have taking shape. Gold ultimately isn't really an inflation hedge as much as it is an uncertainty hedge. And we are in uncertain times. In fact, our Macrovisor 2025 theme was 2025 being a year of uncertainty. So I think gold does well in that environment. I think it hits $3,000 probably within the next month or two. And if not, certainly within the first half of this year. And I believe that really looking at like the near term technicals on it, 2736 is what I'd be looking for. With a push above that, I think we can make new highs. I think that'll release a lot of energy. It'll put buyers back into a much more favorable position. It'll start to put more momentum traders into gold because of the technical health. But that's a key pivot, that 2736.30 on the current gold contract. And the other thing that I think will be beneficial to gold here is just the overall picture of more and more central banks, more and more investors, more and more people overall appreciating that they need to diversify away from just having, paper-based assets or digital assets into something that has some physical, tangible hold, kind of being able to store value over time. Gold's never going to go to zero. And if you hold it physically, there's no counterparty risk. So I think that that becomes more attractive in an environment of increasing uncertainty. If counterparty risk becomes something that percolates people's minds, that also tends to drive a stronger bid into the gold market. So I would say, in 18 months from now, could it be over $3,500 an ounce? I think there's a strong case to be made for that, especially if China stimulates, especially if Trump's able to cut taxes and have a robust fiscal agenda, and we just have more money supply in the world. Remember, China has been the biggest purveyor of global money supply since the great financial crisis. So their monetary and fiscal actions are going to be critical in terms of determining how much more this precious metals rally has to go. And speaking of gold, its cousin silver is even more keyed off of China, because about 50% of demand for silver is industrial, and about 15% of global demand for silver comes from China. It's the second biggest demand center on earth. And if you look at all the indirect demand that goes into China, it's easily the biggest. So what happens with the Chinese economy and their stimulus is also going to have a big impact, not just on gold, but on silver as well, because of that direct industrial utilization if they do, and the lack thereof if they don't. You'll notice every time China talks about stimulus, all the metals get a bid. That is because they are such an important user of raw materials and also a global investor in gold, that any increase in economic activity and money supply coming from that country is a big tailwind. So it's been a fool me thrice scenario. We've heard over and over again for years that China's going to stimulate. They're going to do big, stimulus bazooka. They're going to make sure their economy grows. And yet they've done very little over that same time. So I would say, I wouldn't wait and make bets on the China stimulus as to how much that's going to impact things. But if it does happen and in size, it'll be a nice right tail to really push gold higher and give a durable bid to those industrial metals, in particular silver and copper.
Well, I would argue that the last 14 months, the gold price rally, and I think like back in October 2020, October 2023, because the gold price was in peril back then. There was a ton of articles saying that the gold price was going to crash back down to 1,500. There's no need for it. And then it just started to take off through a lot of 2024. And now it's been building a base for the last, I don't know, 4 or 5 months. I think the demand driver, Mayhem, besides, I think the monthly dollar cost averaging from the non-G7 central banks, that has really been pretty constant for each month. The amount of monthly purchases has been about double since the Russia sanctions in 2022. So each month then prior to the Russia sanctions, it was substantially less than it was post Russia sanctions. It's about double now. So they're dollar cost averaging, but the real demand increases, in my opinion, it's been the retail investor, and they haven't done the China stimulus, but it's been weak currencies in Asia. So it's been what weakness in India, Japan, Korea, Thailand, Vietnam, those weak Asian currencies, the retail investor, the high net worth, the pension funds in those countries, they've been buying a lot of physical gold and silver over the last 14 or 15 months that they really had not bought at the pace in the past.
And that also speaks to answering your initial question, which I wanted to touch on, which is, what do I think of the relative strength gold is seeing, the breakaway of these previous relationships that it's had with a strong dollar or rising real rates? And I think it speaks to those types of flows. It speaks to the idea that the uncertainty and the period of uncertainty that we suspect is to come is greater than the traditional drivers of flows into fixed income or flows out of gold, since indeed it is priced in dollars. So a stronger dollar typically takes the wind out of its sails. I think it tells us also that swinging the bully pulpit of the dollar and the SWIFT system and Western financial system as a way to kind of kick Russia out of the international economy was seen by other countries as, oh, wow, that could happen to us at any time. We need to diversify more away from US treasuries and US dollars and otherwise, because if that ever happens, we need to still have other assets on our central bank's balance sheet to be able to diversify away from that dollar exposure if we're ever frozen out of that dollar system. So I think that it's much to the detriment of using the dollar as a sort of weapon against other countries. The other side of this is it sparked an enormous appetite for gold that's not going to go away. And then adding to that, a strong dollar means the US is essentially exporting that inflation those other countries are experiencing that's causing people to want to buy more gold.
Well, you also have currency weakness too. So in those other countries,
Yes.
and those are not necessarily emerging markets, although their government finances in like Japan and Korea, some of those other countries, they've had government bond problems, debt problems, government mismanagement too, waste. So it's looking like potentially like the 1940s, 1970s type of style here, where you have all these different governments trying to debase the currency or monetize debt. They started cutting interest rates before that, before the Federal Reserve Bank did. A lot of these other central banks did, and it looked like they were doing liquidity programs to try to buy government bonds. So I think like a lot of these locals in these different Asian countries, they saw the weakness in their currency against the dollar. They saw what the government was doing with the central bank, what cutting interest rates, and that they're going to start monetizing debt. And I think that sparked the inflation fears, currency debasement fears in these other countries first. We're just not seeing in the data, Mayhem, that a lot of Americans are not buying gold. It's just not, the demand's not there, and the demand's not there for the gold stocks either.
Yeah, I think they're buying Bitcoin more than they're buying gold. And I think that's
Meme stocks,
especially,
not just Bitcoin. It's not even
yeah.
bit. For suggesting that Bitcoin's better now, man. I'm getting like turned on by people that like, oh, you're not diversifying in meme stocks and all this, or
Well,
altcoins. Meme
clearly,
coins.
clearly, you want to have a large allocation into GameStop and AMC as a part of a long-term investment strategy. To no, of course, I'm kidding, but I
Or
think it is.
Fartcoin.
Yeah, right. Or Fartcoin. I've heard actually there is a use case for Fartcoin, by the way, and the use case is having a way to cap and trade methane emissions.
Oh, so Goldman Sachs is going to buy it, and then they're going to sell it to the lobbyists here in DC as a carbon cap and trade meme coin.
Yeah, and they'll get the cattle ranchers involved, and we'll be really trading an actual, its namesake, Fartcoin will be representative of the first practical large-scale economic use case for an altcoin. So it's actually
They should call it Fartcoin or slash Concoin, and then rename the symbol as Fartcon or something.
or maybe just give it a picture of a cow. I mean, at this point, though, on a more serious note, there's about 2 or 3 million different altcoins out there. This is the greatest amount of different altcoins that have ever existed in any crypto cycle. And I think that speaks to the sheer magnitude of the froth and the euphoria that exists right now. This is the clamoring demand for some of these quantum companies that will probably not exist in a matter of years, as does the sort of, just incredible amount of angst that exists that people will see when they even just present the potential of a left tail scenario that something could go wrong. And there's this cognitive dissonance that kicks up, and people get angry like you're a perma bear if you say anything could go wrong. It's not even like you're saying the market's going to sell off. You're just saying, well, rising rates is a big risk. We should pay attention to that. The fact that markets are making lower highs and lower lows, that's a concern. The fact that liquidity is dropping out and everywhere that we look at it, that's a bit of a concern. The fact that a lot of the tailwinds that drove this are drying up and we're going into the opposite now, an environment of tightening conditions globally. Like, these are things we should be concerned about. 2025 is not looking like it has the same sort of tailwinds that 2024 did. And so that demand for long duration, highly speculative risk, I think it's likely to change. I think it's going to become more important to look for companies with strong balance sheets, free cash flow, this long duration growthy stuff, and even a lot of the crypto stuff. It could take a bit of a downturn in that type of an environment. And one of the ways to gauge that is, what are rates on the long end doing? Are they continuing to climb? What are liquidity measures telling us? What are financial conditions aggregates telling us? What are treasury auctions looking like? Are they continuing to tail? What do we see in some of the most shorted baskets? Are they starting to roll over again? Like, you can start to see when the tide's coming in. And when it does, I do think that we should be a little bit concerned about where ultimately some of these things could go. I think, again, there's going to be opportunities to make money in this market this year. I just think it looks a lot different than last year. And that's probably a good thing. It's a bit of a cleanse. It's a bit of a rotation into places where money needs to go to really rebuild some of the functional, tangible parts of the economy too.
Yeah, there's a lot of risk on, especially by young adults, young adult men and women. I mean, like, there's an insane amount of sports betting on people are doing on their phones. They're doing tons of altcoin crypto trading and meme stocks and stuff like that. It's absolutely nuts. People are like the equivalent of day trading on their phones now, and what prop betting on sports. Just hearing like absolutely insane stories of people gambling like crazy now.
Yeah, I have to say personally, I'm not a fan of that at all. I've been given many opportunities to participate in that space, whether it's in sports betting, whether it's in betting on political outcomes or geopolitical events or any of that kind of stuff. I got approached by a number of different accounts asking me to help to promote tweets and use these platforms. And, I just am very uncomfortable with it. I've declined every one of them because my thing about why I participate in social media, why I built TraderAid, why I, co-founded Macrovisor and all that, is that I want to genuinely help people. I want to help people stay out of the way of blowing up their accounts and getting hurt and never coming back to trading. I don't want them to think of trading as gambling and treat it as gambling. I'd like them to treat it as a business where you buy and sell inventory, capture the spread, diversify your profits into long-term investments. And, you really build a durable model that you can run a marathon with, where you always have capital, where you never take too much risk. And that's not what this stuff is. It's the
Yeah,
opposite. It's the
yeah,
get
things are
rich
headed in the
quick.
wrong direction.
Yeah, and it concerns me because, you know what? A lot of younger people are not learning how to value a company, how to invest capital over time, how to have good risk management practices, because we've been in a very forgiving market for a long time. People haven't really seen what a real bear market looks like, really since '08, if we're being honest. Not in this country. And I think that's reset the expectations of an entire generation or two of investors in a very detrimental way. And then you add to it all this speculative euphoria and fervor and this froth. I just think a lot of people on these edges, the sports betting, the altcoins, sort of like what happened with NFTs, the SPACs, a lot of these quantum companies, all these sort of like super frothy nonsense areas are probably going to be zeroed out. Doesn't mean everything everywhere, doesn't mean it happens tomorrow, but I'm really worried about a lot of these retail folks. So, when I get out there and kind of get on my soapbox about like, where's MicroStrategy going to be in a year or two or three, or where's these quantum computing stocks going from here? Where's Fartcoin going in the long term? It's because I want to get people out of the way. And I take a lot of flack for it because these things have cult-like followings and ardent fan bases that'll troll you to the ends of the earth. But I feel like if I can just reach one person and make sure they don't blow up their account and leave finance as a result of it, I've done my good deed.
Thank you so much for your time today, Mayhem. My listeners want to check out your work, they can go to Macrovisor or TraderAid or watch Aisha Tariq on business television Monday through Friday. And I look forward to our next conversation. I always enjoy them.
Thank you so much for having me, Jason. Really appreciate it. It's always a pleasure and an honor to be on your show among so many other awesome guests, and I look forward to the next such occasion.